Hi, this is Matthew Cratter from Trader University, and today I want to teach you how to avoid dividend stock traps. If you'd like to learn how to make money in the stock market in both bull and bear markets, be sure to hit that subscribe button. So I did a video a few years back about Exxon Mobil, how I thought it was the most dangerous dividend stock that everyone owned. This was back on May 4th of 2018, and we can see on the chart here where Exxon Mobil was trading at that point. You did earn a dividend yield over the last couple years as you watched your stock fall if you own this, but when I made that video, Exxon was trading above 80 and now it's trading in the low 50s. So sometimes getting that nice dividend yield is just not worth it. In this video, I'm going to show you how to avoid stocks that are traps like this, or at least one way to avoid them. So ExxonMobil had an interesting history. It was definitely, obviously, a dividend aristocrat. It had been raising its dividends every year for 25 years. But we can see that by 2018, the dividend yield had gotten above 4%, which is fairly high for a blue chip stock that's not a REIT or an MLP or something like that in this environment. So a lot of people were sucked into this because the dividend yield was so high, especially compared to treasuries and the risk-free rate. We can see that the company continued to raise their dividend payment every year since then, but the stock fell, and so it's still unclear whether, if you hold this for the long term, whether Exxon will ever get back up to those highs, and whether you'll make back the amount of money, also in terms of the opportunity cost that you've lost. So let me show you what I spotted, and so how you can do this as well. I was looking at the cash flow statement, and one thing to be aware of. So this is ExxonMobil cash flow statement. I will put a link in the description notes below. We have the different years here: 2017, 18, 19, and then the last 12 trailing months. But something very interesting happened to ExxonMobil. I believe I was looking at quarterly reports to spot this. But if we look at their free cash flow down here, now free cash flow is the cash thrown off by a company, and it can be used to buy other companies. It can be used to buy back stock. It can be used to retire debt, and it can also be used to pay a dividend. So ExxonMobil always had a fairly healthy free cash flow. We can see that back in 2017, it generated about 14.6 billion. And that year it paid a dividend of 13 billion. So we're already getting pretty close. The dividends are always paid out of free cash flow. You can pay them in stock occasionally, but it's usually a cash payment. And so we're already getting very close. If earnings or free cash flow fell, they weren't going to be able to cover their dividend. The next year was a little bit better: 16 billion of free cash flow, 14 billion in dividends paid. But then as oil prices came down and various other structural things happened, in 2019, their free cash flow fell to just 5.4 billion. They still had to pay this dividend of 14.6 billion in order to maintain their status as a dividend aristocrat. Obviously, a lot of retirees and very conservative investors owned ExxonMobil stock. So what were they forced to do? Well, they were forced to increase their debt, and this was something that they had actually been doing over a very long period of time. So here's ExxonMobil. Here's an old Value Line report from August of 2019. You can get these for free online just by Googling the stock ticker if it's a member of the Dow 30, the Dow Jones Industrials Average, and just type in XOM Value Line PDF. I'll also link to this in the description notes below. But we can see what happened with ExxonMobil and its long-term debt, which is over here. Back in, let's see where this starts. So 2009, let's scroll in a little bit here. So in 2009, they had long-term debt of about 7 billion. And we can see that it's just gone up over the years as they have been forced to increase their debt, their long-term debt, thus making the company more risky. As of the last 12 months, or as of, I guess the last 12 months or 2019, they're up to 20 billion. So the way they've been paying their dividend is by borrowing the money. Now, this is not how dividend stocks should normally work. If you have a healthy business, it should be continuing to churn off, throw off is the word I'm looking for. It should continue to throw off free cash flow, and this can be used to pay an ever-rising dividend. Now, the market began to sniff this out as the dividend yield moved above 4%, almost to 5%. People, traders, investors, big institutional funds were noticing how the company was having to lever up in the wake of lower oil prices and some other things, and taking their debt up from $7 billion all the way up to, I guess, the year before in 2016, they'd actually gotten up to $28 billion. So they've been delevering slightly. But nevertheless, the fact remains that they were borrowing to pay the dividend. So this can be a huge red flag and a reason that you shouldn't get sucked in to an abnormally high dividend yield. You want to see the dividends being paid out of free cash flow. You want to see that for every year, the free cash flow is well above the dividend payment. So even back in 2017, this was beginning to cut things pretty close, just having $1.6 billion difference, especially considering how volatile oil prices are. It's fairly hard to predict the earnings for an oil company from year to year. But once their dividend payment as a percentage of earnings or free cash flow gets high enough, and this is one reason you want to usually look at companies that have a dividend payout ratio, which is just dividends divided by earnings of somewhere, I'd say usually 60% or below. Once these get really close, they can no longer cover their dividend, and they're forced instead to lever up the company. Maybe they'll sell stock to pay the dividend. That would be even worse because you're getting diluted. They're basically taking money out of one of your pockets and putting it into another pocket. So this is the main warning sign of how to avoid dividend stock traps. There are a bunch more of these. I'm going to make more videos about them. I'm also offering a new service if you don't want to have to worry about digging into this stuff and you just want to follow along as I invest. Starting tomorrow, actually, I'm going to be starting to invest a new dividend stock account, and I'm going to be using $100,000 of my own money. Approximately every week, I'll buy a new dividend stock. And so you can see what price I'm paying, and as part of that, I will also analyze the company, why I'm buying the stock. I'll take a look at its dividend coverage ratios, its leverage, and really teach you to find your way around the financial statement so you can learn how to do this yourself. Again, this won't be investment recommendations, but you will get to peek inside of my own account and see where I'm allocating my own money in the dividend space. Now, if you sign up for this, you'll also get access to all of my online courses. I have about 13 courses right now: day trading, swing trading, futures, options, make money with IPOs, as well as a real estate course and a financial statement analysis course. So if you sign up for it, you can just go right up here, follow my trades, follow my dividend stock portfolio. You'll also get access to seeing what I'm doing, how I'm investing in Bitcoin, and possibly other cryptos. If you're interested in this, just click the description notes below. It'll take you to the Follow My Dividend Stock Portfolio page, or it'll take you to this course page. I'll put in links to both of them. And if this is something you're interested in, you can just scroll down to the bottom here, click the Get It Now button, and it will take you to the checkout page. Now, normally tuition is just $125 for 30 days access. That'll get you access to Follow My Dividend Portfolio, Follow My Crypto Portfolio, and all 13 courses. But because we're still in a recession, I wanted to give you guys a special coupon. So if you go down here and click Have a Coupon Code, type in YT as in YouTube 99, click Update, and that'll take $26 off the 30-day access price. So get access to everything, including Follow My Dividend Stock Portfolio, for just $99 for 30 days. You can watch all the courses, watch my first 4 dividend picks, and then cancel at any time. You won't be charged again. And there are no long-term contracts or anything like that. So if you're interested, check out the links in the description notes below, and hit that like and subscribe buttons if you found this video helpful. Let me know your questions and comments in the comment section below, and hope you're all staying well. I look forward to seeing you guys in the next video.